Candlestick patterns for beginners. Unlocking market insights. Candlestick patterns are graphical representations of price movements in financial markets, including the Forex market. They provide valuable insights into market sentiment and can help traders make informed trading decisions. Understanding candlestick patterns is essential for beginners as it allows them to recognize potential trend reversals, continuation patterns, and market entry or exit points. Here are some common candlestick patterns that beginners should be familiar with. Doji. The doji candlestick pattern is characterized by a small body, with upper and lower shadows of similar lengths, indicating indecision in the market. It suggests that buyers and sellers are in equilibrium, and a potential trend reversal may occur. A doji, at key support or resistance levels, can provide valuable insights into market sentiment and potential turning points. Hammer and Hanging Man. The hammer and hanging man candlestick patterns have similar shapes but appear in different contexts. A hammer has a small body at the top and a long lower shadow, indicating a potential bullish reversal after a downtrend. On the other hand, a hanging man has a small body at the bottom and a long upper shadow, signaling a potential bearish reversal after an uptrend. Engulfing patterns. Engulfing patterns occur when a larger candle completely engulfs the previous smaller candle. There are two types of engulfing patterns: bullish engulfing and bearish engulfing. A bullish engulfing pattern forms at the bottom of a downtrend and indicates a potential bullish reversal. Conversely, a bearish engulfing pattern forms at the top of an uptrend and suggests a potential bearish reversal. Morning star and evening star. The morning star and evening star patterns are three candlestick patterns that indicate potential trend reversals. The morning star consists of a bearish candle, followed by a small-bodied candle, doji or spinning top, that represents market indecision, and finally, a bullish candle. This pattern suggests a potential bullish reversal. The evening star pattern is the opposite, indicating a potential bearish reversal. Shooting star and inverted hammer. The shooting star and inverted hammer patterns have similar shapes but appear in different contexts. A shooting star has a long upper shadow, a small body, and little to no lower shadow. It suggests a potential bearish reversal after an uptrend. Conversely, an inverted hammer has a long lower shadow, a small body, and little to no upper shadow, indicating a potential bullish reversal after a downtrend. Bullish and bearish Harami. The Harami pattern consists of two candles, with the second candle's body contained within the range of the previous candle. A bullish Harami occurs when the first candle is a larger bearish candle, followed by a smaller bullish candle. It suggests a potential bullish reversal. Conversely, a bearish Harami occurs when the first candle is a larger bullish candle, followed by a smaller bearish candle, indicating a potential bearish reversal. Conclusion. Understanding candlestick patterns is a fundamental skill for beginner traders in the Forex market. These patterns provide insights into market sentiment and potential trend reversals. By recognizing and interpreting common candlestick patterns, such as doji, hammer, engulfing patterns, morning star, evening star, shooting star, inverted hammer, Harami, and tweezer tops and bottoms, beginners can unlock valuable market insights and make more informed trading decisions. It's important to practice identifying these patterns on historical charts and combine them with other technical analysis tools to enhance their effectiveness.